99% of the time, you're going to get a far more favorable cover through a group scheme. Plus, in a group scheme, they're not going to go and underwrite every single member.
Sick people and the healthy people and healthy lives are all blended together, and so the insurer takes a view. And you mentioned something that was, I guess I'd never thought about before, and that is that there's an expiry date on a group insurance, because it's by virtue of your employment, and that generally ends at retirement age.
Life cover now, most people are working past retirement age. So insurers are allowing retirement cover past that to age 70 or even 80, some insurers. So that's another value add for members that maybe are not that insurable.
Hi, everybody, and welcome back to EBnet.Stream for today's episode of Industry Insights. I'm joined by Corinne da Silva, who is the Executive Head of Risk at Jigsaw Financial Services, for a conversation I've been looking forward to for a couple of weeks now, and that is around group risk benefits. But before we get into those, let's welcome Corinne to the show.
Hi, Natalie, and thank you for inviting me to chat today. I'm looking forward to it.
Definitely me too, because I think risk benefits, particularly on a group basis, can sometimes be misunderstood, can sometimes be regarded as quite technical or complicated. And so I'm hoping we can demystify some of these things for either retirement fund members or employees out there, maybe their human capital divisions and businesses. And for the odd IFA who might be listening to this, I'm hoping we can demystify some of the technical content and some of the technical words. So before we get into that, let's start at the basics.
Okay.
What are the benefits of group risk policies?
Okay, there's a number of benefits, Natalie. The first benefit is it's based on a group. So first, and it's a group that doesn't really have the choice. So when you join an employer will have certain benefits available to you. Hopefully, when you're employed, they've already got this in place. If they haven't, they're going to put it in place. So if an employer puts benefits in place for its employees, they're not really choosing to join that scheme. It's part of their employment contract. Taking that into account, an insurer will look at that and say, okay, if it's an individual policy, it's a choice you're making. So there's an element of risk. Okay, they don't know anything about you, and they're insuring your life, and probably for your entire life, however long or short it's going to be. And they're going to look at, they're going to look at your education, and they're going to look at whether you're a smoker and your age and the salary, the same things that on the group side they will look at, except they're not going to take into account whether you're a smoker. They're not going to look at that, but they are going to look at what are you employed as, what's your occupation, where are you based, okay, in terms of the risk, how much do you earn, because depending on how much you earn will depend on how much access you have to healthcare, etc., to look after yourself, to feed yourself correctly. So those things are still there that would be in a life policy. However, because it's group-based, okay, and they're going to make certain assumptions based on statistics with how many people of that group are likely to pass away. Right. And they do that every year. They have a base rate on the entire book that they look at, and then they break it down into an industry, into a salary group, and each insurer will have their way of looking at those two kind of rates. So you are expecting, because of that the rates are going to be cheaper than if you go and buy an individual policy. They are smoothed. They are smoothed. So you might have a bunch of asset managers saying, and they're young, I'm sure I can get this cover a lot cheaper. Then they would have to do the comparison. But 99% of the time, you're going to get a far more favorable cover through a group scheme. Plus, in a group scheme, they're not going to go and underwrite every single member. An underwriter, I mean, they're not, if you take out a life policy, you are requested to go for medicals. And then based on those medicals, they set the premium. Okay. They don't do that in the group space. They are going to say, determine, okay, I'm going to take, based on the profile of this company, I'm prepared to take X amount of risk. Therefore, everyone that has cover below that amount, I don't need to know how healthy they are, what their health status is. But anyone above that, that's a high risk for me in this group. So I'm going to ask them for medicals over and above that cover. So everyone will in that group. So all the insurers will offer that cover limit, what they call a free cover limit. So it's not for free, but it's cover that you are getting without needing to go for medicals. So that covers in place irrespective. And if you're an executive with a high amount of cover and you requested to go for medicals because your cover amount's over that limit, should you fail that, no, that you won't go to naught. You will still retain that free cover limit. On the disability side, if you have to go for those medicals and you fail that medical, or they say, well, you know, you've had back problems. That's a slight risk for me. So we are going to cap the amount of risk we're going to take on that. So then you will get the free cover limit, irrespective of the reason for disability. But should it be because of that back problem you had, you're not going to get the full cover.
Okay.
Okay. So they'll give you your full cover. Okay, and you will get that full cover. But if it's due to the reason that they say, so that's an exclusion clause they will put on to a member's letter. So ideally, what I'm trying to say is it gives insurance to the uninsurable, some level of cover.
Yeah. And so I was just about to say the key takeaways from our conversation so far is that because group risk is compulsory, there is this this avoidance of anti-selection, and that's the kind of sick people looking for insurance cover. And so the insurers send them for medicals and send them to go and get their health validated and to go and look at all the nitties and gritties about Natalie's personal health, versus on a group arrangement where it's compulsory, which means the sick people and the healthy people and healthy lives are all blended together. And so the insurer takes a view. And you mentioned something that was, I guess I'd never thought about before, and that is that there's an expiry date on a group insurance, because it's by virtue of your employment, and that generally ends at retirement age. So it's not like my personal life policy, which I could ostensibly hold until the day I die, and then the event is actually guaranteed.
Yes. So in effect, a group policy we call a term policy.
Right.
And that term is your employment term.
Okay.
And then the interesting part, Natalie, is that today most cover and retirement funds used to have cover up to age 65 on life cover. Okay. And life cover now, most people are working past retirement age. So insurers are allowing retirement cover past that to age 70 or even 80, some insurers. So that's another value add for members that maybe are not that insurable, that they've got covered to age 80 while they're still in employment.
I'm with you. The other benefit is of a group scheme is not only this insurability of potentially unhealthy lives, or of individuals who may not be insurable in a normal individual, I nearly said freestanding policy, but that's the wrong wording, but in an individual capacity is a better way of saying that. The other obvious attraction is the rates. And how cheap this cover is. So you guaranteed cover, as Corinne said, you guaranteed cover up to this free cover limit, and it's it's generally cheaper. No, it's not, you know,
It is
it's
generally
not
cheaper.
so it's not 100% it's going to be cheaper, but it generally is. And so even I feel comfortable saying that. But there is one, when I talk about cheaper rates, there is one thing that always sits in the back of my mind, and that is the Sanlam benchmark survey, which we saw last year, really highlighting and surfacing the increase in rates for these group types of benefits. And are we expecting retirement funds? Because in a defined contribution retirement fund, if I'm buying insurance benefits, I'm not saving for retirement. All the members are going to retire, or you know, or access their fund credits or fund values, but not all the members are going to submit a claim. So what would your commentary be around the competitiveness of rates right now?
Okay, so Natalie, as you know, COVID was one of those times where insurance companies were hit hard. And the reason why they were hit so hard is because COVID hit all sectors of the market. Whether you were executive and middle income or lower income, didn't matter. We were all hit by COVID, and there was a large amount of claims, especially in that high income bracket. So that forced rates up between 20 and 30% in some instances. Most insurers put their rates up because, as they would say, you know, they were paying out extremely large sums of in terms of claims, but yet their disability claims over COVID were low.
Okay.
Lower. But post-COVID, you had an increase in disability claims because people that didn't go and get checked out and go to the doctor for their normal checkups and make sure they were taking the right medication, example, were the ones that became potential claimants. Plus, we had the mental health issues that surfaced post-COVID. But even on the death claim side, although the death rate evened out, we still have higher death rates than pre-COVID. And the reason for that is that a lot of people that might not have got that care that they should have, or gone for the scans that they should have gone for, might have got cancer or heart issues during that period. And that's where we see a high increase, and that's increased critical illness claims, disability claims, and then ultimately could increase death claims because they actually don't survive. So we're still not to pre-COVID levels in terms of claims. Yet, we are seeing the rates that in the market start to come down, okay, for those levels of cover. And it is becoming more competitive. But I wouldn't say that you're paying pre-COVID rates yet.
Could we expect pre-COVID rates?
I really can't. I mean, I remember reading some, and I'm going off memory here, but I think 2024, the insurance industry paid out the most claims.
Wow.
And there was then in history. And if I think about the actual competition again in the market, because remember, in the group space, an advisor, an employer is going to look to maximize retirement savings. So they are going to look at where can we get the best cover for our employees at the lowest cost. So and there's only so much business, so many employers for that risk cover, and you've got a lot of insurers competing for that. So that does create the competitive market, but it does also put pressure. So I'm also one of those that says, you know, if the rates, you've got to look at your own employer scheme and look for sustainable, because you don't want to have a rate that's 20% lower this year, but 30% higher next year, because you're having a lot of up, down. Yeah, it's not you're looking for rates that are going to be steady, so that your investment returns are in line, and you're not taking away from investment because you're paying a higher premium, although you're getting the 20% discount the year before. So it's almost, you've got to weigh it up and do the numbers. And that's where your advisor becomes extremely important. Not only looking at cost of the cover, but looking at the T's and C's, Natalie, and T's and C's between the insurers. Because like I said to you, it can be simple or it can be complicated. And there could be that one claim that can be affected due to a T or C that was overlooked. And you've got to understand your employer. So it's advice in our sector is so vital, especially when it comes to risk benefits. And I know that advisors have got so much on their plate with investments and pension fund legislation. There's so much legislation around employee benefits at the moment that to try and keep up with everything is it's a nightmare. So you really got to look for the support in the market to help you make sure that you're giving your employer and employers are making the right decisions around their benefits.
So I'm so glad you mentioned and raised this T's and C's. And in fact, as I glance up at my screen, I see I actually called this interview Group Risk T's and C's.
Yes.
So it's almost like I foresaw we'd be going down this road because, rates is one thing, Corinne, and we're all very mindful of overspending, value for money, costs and fees in retirement funds and group structures.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
But sometimes cheaper is not better. And I think this is what you were alluding to about the importance of advice. And as someone who deals with these types of benefits all the time, what are the major, let's call them T's and C's, or the major riders on the policy, on group policies that perhaps employers should be aware of, or a new financial advisor listening to this should look out for?
Okay, so in terms of general T's and C's on basic cover, you would look, and as an advisor, you would look for, you would need to make sure you've got conversion option included. We quote automatically including. We'd rather have you say, no, we don't want that. Because again, that is going to cover somebody that if they leave the employer of the employer and they are uninsurable, they're able to convert that to an individual policy that cover. Obviously, they're not going to pay the same premium. It's going to be more expensive. But at least they will have continued cover for life cover, disability cover. Now, remember, disability cover is there. It's either paid as a lump sum, and it's either an accelerated benefit where that's what we call a capital disability benefit. And it has its own definition. It's normally quite a stringent definition. It doesn't just take into what you do currently, it takes into account any occupation that you are able to do, and you need to be permanently disabled. So that's your lump sum disability benefit. That's normally a rider benefit on your life cover. Okay. That benefit, there's not much you can make sure you have there in terms of riders, but your the T's and C's. So normally that benefit, especially if you've got older members, and a lot of employers nowadays do keep employees a lot longer than they used to years ago. So there you would normally have a taper. Do you want a taper or not a taper? Then you have the monthly disability benefit. Now that is the most popular one because that replaces your income should you become temporary or permanently disabled. And there you can have quite a few riders, and then that's where you find most of the T's and C's. Because life cover is generally life cover, and besides war and riot, which is the biggest T&C and your territorial limitations, there's not much more. A lot of insurers just have fraud as a T&C. Some insurers will actually specify that if you are being involved in fraud or misconduct or a crime, you might, as a beneficiary, will not be able to take a benefit. Okay. So that's the only real T's and C's on a group life, unless it's a really small scheme. Rider benefits on group life is you can have flex cover. So flex cover is where an employer wants to allow members choice. So instead of them going out to buy additional cover in their personal capacity, they can buy that voluntary cover under their group scheme. So that's an add-on. Another add-on, trying to think quickly, is if it's an approved risk. Okay, so now approved and unapproved. Approved risk is where the cover is done through the retirement fund and the policy holder is the retirement fund. There you can add on a tax saver benefit to ensure that if you are insuring 2 times annual salary, that 2 times annual salary goes to the beneficiary that is nominated by in terms of 37C. Okay. That's a tax saver benefit. So those are your rider benefits. And you can add an accidental death benefit. In other words, it can top up your life cover if it's due to an accident. Those are your rider benefits. But disability is where you find majority of your exclusions. So remember that whole free cover limit? Okay. So there's the way an insurance company mitigates their risk, because they don't know your health status. They're going to look at, okay, so are you at work on the day cover starts? That will apply for life cover and disability cover. Are you at work the day that your cover starts? Okay. Not if you're on leave. I was on leave my first day. But you have to be seen to be actively at work and not off sick. You need to, they will look at any condition you suffered or suffering from or being diagnosed 6 months prior to joining that company or that level of cover, that cover. You cannot claim for that for 12 months. So it's almost like for that condition or that underlying or diagnosis, you can't claim for 12 months. Okay. So that's a big one. Self-inflicted injury. Some will have an exclusion of you cannot claim if you've abused alcohol, drugs, if it's all drug-related alcohol. And then some will also exclude hazardous pursuits for disability. And those that I do know of that have got it in their policy, not everyone's got it in their policy, will state scuba diving, jumping out of aeroplanes, speed tests. Okay.
And drugs.
Yeah. Yeah. So certain insurers will still have that in their policy. Some will just say, are you being negligent? So, or self-inflicted. Now, I know one policy says that unless you are disabled, but if you had to throw yourself in front of a bus to save another human life and you're disabled, they're not going to say that's self-inflicted. You were attempting to save a life. Okay. So those are the important T's and C's that employers need to know for members that are joining or when they join cover for the first time. Okay. When you transfer in cover, those things normally get waived. We call them pre-existing conditions. That's 6 months prior, 12 months post. But your add-ons there, on a monthly disability, there's a period that the insurer will say the employer needs to cover that member. And that's called a waiting period. And that period is to determine whether the person's going to return to work or they're going to remain disabled. The most common waiting period is 3 or 6 months, although the market has been pushing towards a 1-month waiting period, which makes it quite expensive. Then there's another benefit, Adam, if you take a 3-month waiting period, the employer can insure that 3 months. So if someone is actually determined to be disabled, there's what we call a payback, a waiting period payback benefit. Okay, so that's where, say the employer did cover the member who's been off, they will get refunded. If the member had to claim from UIF, while they did, because they'd exhausted sick leave and annual leave, there is that payment back to the member. Okay, so that's an add-on. It'll cover, there's waiver benefits that will cover the retirement benefit should a member go on disability. Continued cover, something we automatically include on our when we quote for life cover, is that when if you're disabled, your life cover will continue, and so will your funeral benefit, or critical illness, which they call dread disease benefits. Okay, those, if we quoting on those, we automatically include cover to continue, because if you are disabled, you generally want to know that those benefits are going to continue. And because it could be a disability claim that where your lifespan's not going to last to retirement, and then you still have that cover in place.
And it's not only you receiving the benefit, it's the employer who still has to fund various costs in respect of the disabled person. So it's not only insurance for the members or your employees themselves, it's also for you as an employer to cover some of these future costs.
And you know what we're finding is that, in the time I've been in insurance, there's members that you can get back to work, or you can work with rehabilitation. Okay, and those are important to try and get the member back to work. It's good for their mental health, good for as human beings, we want to add value in society, and you get those that have enough education that can do something else. We've had some wonderful cases where someone's young, they're disabled, they're in a wheelchair, they can't do what they used to do, but they want to work, they've got a young family, they need to provide to the family and to provide to society. And that's where insurers can jump in and do the rehabilitation. But what we are finding today is that there's less and less of members returning to work for alternate positions. And that is where there's also a strain on disability, where you would normally be getting more members back to the workplace, the disability being more temporary or being able to offer something alternative. And so that sometimes gets harder. So it's such an interesting disability on its own is so interesting. But another thing, that is really important in T's and C's, and I've seen it so many times, is that it's important for employers to be aware of the T's and C's. I've seen so many cases go wrong, and because of misunderstanding or the wrong cover being put in place. So it's really important, especially if you're moving cover, and I'm talking to advisors now and employers, that you have a proper check. Is, are you moving the client? Are they aware of the changes in T's and C's? And legislation actually push it. You have to provide that now. You have to provide communication right down to member level. And I do believe as an industry, we're not yet at the level where we are providing that in a way that the member understands. So they're doing a tick box, but does the member actually understand the differences between the small T's and C's?
Yeah, and look, I mean, Kofi's going to get into that as well. So we do have the policyholder protection rules, sure, where the communication needs to go to members, but Kofi's going to get right up into that about outcomes, and so it really highlights, and I think for anybody listening to this, I think the one message that I'd love for you to take away from this chat with Corinne is that group policies are different. and particularly on the T's and C's and the fine print, let's just call it that,
Yeah.
and the importance of understanding that it's not just about the cheapest rate. It's
No.
about what's in the basket and what's out the basket of benefits. And there is such a high degree of care and attention to detail needed there. And off the top of your head, Corinne, I mean, before we started recording, I was saying that,
Yes.
you've forgotten more about death and disability cover than I'll ever know. But so to tap into that, I mean, what are the top 3, top 4 kind of most common mistakes you see when cover is moved or cover is put into place that you could maybe surface for somebody listening to this?
Okay, so the most common ones is where the waiting periods are not matching. So somebody's worse off. Another common thing is that people say, okay, it's 3 times cover, just give me a quote on 3 times cover. But 3 times cover of what? Pensionable salary, total cost to company. And sometimes you have a benefit that is insured on the risk salary, but costed on the pensionable salary because it's linked with the retirement fund. So it's very important when you quote that you get that right. And again, like I said, does the current scheme have cover to continue? Does the current scheme have conversion option? Is there a medical aid premium waiver? Is there a retirement fund waiver? And how much is that retirement fund waiver? We also have a lot of cases where retirement funds are offering quite a bit of choice now. So your retirement fund contributions can vary anything from 8% to 20%, for example. And so you have members in different categories. How do you define that waiver? Are you doing an average waiver? Are you doing a full waiver across, or are you doing waivers according to category? Those things affect cost. Those things affect cover. So those are small nuances that you think is not going to play a role. It plays a role in the costing. It plays a role in where you're placing the business. And for us, what that's vitally important is understanding, for the advisor to understand that advice part. So before, so doing the advice part and then going to the insurance saying, this is the employer, this is what they require, almost giving them a little bit of a background. This is what they do. Especially examples, engineers. You can have so many different types of engineers.
True.
You know, and it's such a wide variety. And you can have guys that are sitting behind a desk and they're engineers, but you can have guys on the field. I mean, on the out there with the guys, and it's high risk. And so you've got to determine that risk properly, because that can also be a problem come claim stage.
And the other thing is, the other gap is not only between different insurers, but also between what the employer has promised the employee, what's in the retirement fund rules, and then what is covered in the insurance policy. So there's another kind of gap that I can see as well. And to get those 3 aligned is hugely, hugely important. But while I've got you on the call, and I've always wanted to ask somebody this, so given that you're so knowledgeable and you're happy to answer all my questions today, perhaps you can ask a personal one, or answer a personal one. If I'm the type of person who enjoys jumping out of airplanes, which you mentioned earlier, and you mentioned hazardous pursuits, and this is something that I get asked often. So if I'm hanging out in Dubai for the weekend and I want to jump over the palm and I want to do a skydive, am I covered for my group risk arrangements?
So, like I said to you, you have a free cover limit where the insurer's not really going to know what you're doing. Okay, so like I said to you, you've got insurers that will actually specify hazardous pursuits as an exclusion on disability cover, not on death cover. So we have this joke that if you're going to jump out of a plane, make sure if something happens, you don't survive it.
Sure.
Which is a terrible thing to say. But there are policies out there that are quiet on that. even
Okay.
under disability. So it's vitally important that you understand what it is that your policy says. And it's something that we discussed the other day. There's a couple of things that in the policyholder protection rules that you are required to disclose. And we do that. And what I'm finding, these other scenarios, like hazardous pursuits, like underwriting terms, that aren't always disclosed in the PPR because maybe it's something the member's not going to understand. But I do think it should be.
That's an interesting one in a Kofi world.
Yeah. So we actually are adding that to our member communication. So those small things that we've picked up that maybe there was a gap and it should have been better explained to a member. So there are certain things that we believe that a new employee should be made aware of when they join, what the T's and C's of their cover is. Okay. So besides the HR and the employer understanding, because it's an employer-based policy and they would normally make the overall decision, members do need to understand because they're the ones that are going to get frustrated if they claim and their claim's not accepted. And we've seen it. And that's sometimes where the poor insurer gets a bad rep because, you know, someone's just simply didn't understand the policy terms and conditions. And most, in all my career with insurers, I've always found them to look to pay a valid claim than to not pay a valid claim. And that's always been my experience from working in claims departments at insurers over my career, being involved in many claims that are disputed or an issue. But it is, you know, again, how do we get it to the member that they can understand it? I've often done presentations and asked questions afterwards, even to our youngsters. Did you understand what I was saying? I think so. You know? And in the past, it was easy. We just said, you know, you covered for 3 times your annual salary. If you're disabled, you will receive a monthly benefit. You know, that's how simple it is. But it's not that simple. And I think it's important for advisors to always check the policy, the employers to check the policy. If they're not understanding, to come back to ask the questions of a specialist, of a risk provider, of the insurer to explain it to them so that they can understand. And hopefully more and more policies are written in a way that everyone can understand it.
And really points to the importance of your product specific training as a rep, you know, to keep your PST up to date.
Crucial.
Yeah. And I know it's a pain. I know there's lists and lists of things that you need to know about. But when you have a conversation like this and you surface these, some of them are very highly nuanced gaps and differences is a better word, differences between these types of products and policies. You start understanding how important that PST is.
Yeah, one thing I just thought of while we were chatting is that another thing is maximums. Each insurer have maximums on their benefits. Okay. And we've seen a case where someone is moved and the maximum was different and it was only picked up afterwards. Okay. It got, you know, you make plans and you sort it, but you don't want that to happen. You don't want it to arise. We've had claims where, you know, benefits have been moved and an exec who thought he was covered wasn't covered because of a T's and C that was overlooked. So it's very important for an advisor, and I do believe it's important that they are regularly kept up to date.
Corinne, I know I have to let you go because I know you have a hard close.
Yes,
so on that very important point. I think let's stop our conversation and end it there. But I can definitely see us chatting again,
Okay.
and I do look forward to that. So thank you very much for sharing your insights with us today.
No, it's a pleasure. Thanks, Natalie. And have a lovely day.
You
Chat
too.
soon. Thanks.